In problem 7, we're going to explore some more shortcomings of discretionary fiscal policy. In problem 6, we explored one of the major criticisms of fiscal policy lag. Fiscal policy has sometimes intentional and unintentional lags to it. The second major criticism of fiscal policy is the crowd-out effect. And the best way to answer this question is to go to my teaching page, download PowerPoint 5. What is the crowd-out effect? When government wants to stimulate the economy out of a recession, when politicians, Democrats, Republicans in the House and Senate, and the President, typically they compromise and they go with a tax cut and an increase in government spending. That blows up the budget deficit. So we have an increase in the budget deficit. Because we have this larger budget deficit, demand for loanable funds goes up, which drives real rates of interest up. When real rates of interest go up, private investment declines. So real rate of interest goes up, investment goes down. Those two things have a dampening effect on fiscal policy. In an open economy like the United States' economy, high interest rates attract foreign capital. As foreigners buy more dollars to buy more U.S. bonds and other financial assets, the dollar appreciates. The appreciation of the dollar causes net exports to fall. Lower exports and private investment and higher interest rates all offset the expansionary effect of a budget deficit. Now we can answer part A of this Engage Now problem 7. According to the crowd-out effect, financing a large fiscal stimulus bill with government securities places upward pressure on interest rates. This reduces private investment. In an open economy like the United States' economy, high interest rates attract foreign capital. As foreigners buy more dollars to buy treasuries, the dollar appreciates. This causes net exports to decline. Lower exports and private investment completely offsets the expansionary impact of a budget deficit. A third major criticism of fiscal policy is from rational expectations theory. According to this theory, budget deficits merely substitute future taxes for current taxes. If government runs a huge budget deficit and households do not anticipate higher future taxes, aggregate demand would increase. However, if households fully anticipate higher future taxes, they save instead of spend, which means aggregate demand remains unchanged. So their expectations of future income are a lot smaller in the future. And this effect offsets the stimulus effect of running a big budget deficit. To finance a budget deficit, the government borrows in the loanable funds market. So demand for loanable funds goes way up. The government needs cash. People save to pay expected higher future taxes. So loanable funds supply increases as well. The difference between Q2 and Q1 is the amount of the budget deficit, and notice the real rate of interest has not changed. So monetary policy, according to the Chicago School, is preferred because fiscal policy exerts no effect on real rates of interest, real GDP, or the unemployment rate. Now we can answer part B of question 7 in Engage Now. If rational expectations theory holds, households will anticipate higher taxes in the future after the President and Congress cut taxes and or raise government expenditure to stimulate the economy out of a recessionary gap. Households save monies received from stimulus bills, which implies that aggregate demand is unaffected when fiscal stimulus is adopted. To finance a budget deficit, the government borrows money in the loanable funds market. This increases loanable funds demand. Because rational households save monies received from stimulus bills, loanable funds supply increases. Higher demand for and higher supply of loanable funds results in no change in interest rates. Thus, the Chicago School's rational expectations theory predicts that fiscal policy is pointless since it has no effect on real GDP, unemployment, or interest rates. Critics of fiscal policy say it is ineffective and destabilizing because, 1, the size of the needed fiscal stimulus is not predictable. 2, the effects of fiscal stimulus are delayed because recessionary gaps are observed months after they occur. 3, the effects of fiscal stimulus bills are delayed by congressional debates, amendments, and filibusters. And 4, fiscal policy's effects can be delayed by the revenue from new taxes being collected a year or more after the change was made, the provisions of a policy change being purposely lagged for a year or more, federal departments altering their budgets, federal departments adjusting their spending habits, federal departments screening grant or transfer payment applications. So all of the above. Suppose a $1 billion auction of a treasury security has a face value of $100, a maturity of 1 year. In scenario A, the auction ends with a stop-out price of $89.60, but in scenario B, it ends with a stop-out price of $97.01. Using this equation, we're going to compute the yield. These numbers and the equation have already been copied and pasted into Excel. So I need to calculate the yield on bond A and the yield on bond B using this equation right here. So I take the ratio of the face value and price, raise that to 1 divided by the maturity, in this case 1, and then I subtract off 1. And I get a yield on bond A of 11.607%. I'm going to copy that equation and paste it over here. I'm just going to move the price to here. So I have the face value divided by the price raised to 1 over the maturity level. Then I'm going to subtract off 1. So bond B has a yield to maturity of 3.082. Bond A has a yield to maturity of 11.607. I don't need the percent symbol because I have it right here. Again, I don't need the percent symbol. Compute the number of the 1-year securities that must be issued in both scenarios. To compute the number of type A bonds that are needed to be sold, we divide the auction size, $1 billion, by the price. So the federal government needs to auction off 11.16 billion bonds at a price of 89.6. Copying that equation over here, when the price is a lot higher, the government only needs to issue 10.308 billion bonds. We need 0 decimal places, so this would be a n and 6. Do not copy in the commas because sometimes Cengage now doesn't know what to do with commas. And then for the number issued in scenario A, that would end in 4. Again, no commas. So in summary, the lower price bond has a higher yield to maturity, and more of them have to be issued to raise the $1 billion. Now we want to compute the interest payment on the $18 trillion debt under both scenarios. The interest payment for scenario A is found by taking $18 trillion and multiplying by the yield to maturity. We're going to multiply the $18 trillion times the yield to maturity for scenario B. Cengage now wanted these answers in billions of dollars, so we're going to divide the $1 trillion interest payment by $1 billion. For scenario B, we have $555 billion. For scenario A, we have $2.089 trillion, or $2,089 billion. So I copied in the $555 billion into scenario B's interest payment, and then we're going to paste in scenario A's interest payment of $2,089 billion, or $2.089 billion. More government securities must be sold when interest rates are high. The budget deficit is higher when interest rates are high. The prices of securities and interest rates are negatively related. That is true. The national debt grows faster when interest rates are high because interest payments are higher. The Fed can set a price floor on securities by buying them directly from Treasury. That is also true. So all of these are true. The difference in these two values is how much higher the annual budget deficit will be if interest rates are 11.607% rather than 3.082%, which is the answer to the last part of this problem. I'm going to check my work and I should get everything correct. And it looks like I do.